Good afternoon and welcome to the Winter 2023 Linneman Associates Capital Markets webinar presented by Linneman Associates in Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the CRE business since 2009. We're pleased to have an insightful program for you today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform, and I'll just address a couple of housekeeping items before we get started. On the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant, and that's by design and will remain the case throughout the webinar. If you're attending by computer, take a moment to familiarize or reacquaint yourself with the control panel elements. We will be showing the slides, but if you'd like to download them, you can find them in the handout section. Just click on the file name and it will download. You don't need to have the slides up during the presentation because they'll show in the viewer window, but you're certainly welcome to keep them for future reference. As usual, we've reserved 15 to 20 minutes at the end of the webinar to answer questions. Feel free to submit your questions at any time by clicking in the questions field. Type in the question and make sure you click the send button. If at any point you get disconnected, just reconnect the way you did originally. And if you are registered, you will automatically receive an email link to the recording of the webinar about an hour after we wrap up today. And without any further ado, I'd like to introduce our presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, I can't believe it's been another 3 months since the last one. How are you doing?
Well, not as well as I hoped I'd be doing today. I was hoping that we'd still be celebrating the Eagles winning the Super Bowl. But for those of you in Kansas City, you're happy. No, it was a great game, and everything is really lovely. It's actually a beautiful day here, and so it's great to have everybody join. Bruce, let's go through the slides per normal. The first slide is a new nomenclature I've adopted, which is we're living through economic long COVID. And as we know, sadly, many individuals have lingering and some serious lingering effects from COVID that just won't go away, even though you think they should go away. But they don't. And we're living through economic long COVID. What does that mean? Real GDP is lagging its pre-pandemic level, even though it's growing, and even though it is higher than pre-pandemic, it's lagging in terms of where it should be. Similarly, we have a lagging labor force. People dropped out, especially those in their 60s and over, dropped out of the labor force and have not come back. The younger people have basically come back, but the seniors still is a gap. We had supply chain problems. We had lagging supply. We had regulatory delivery issues, etc. And we are having to work through those. As a result of that, we had inflation appear out of nowhere. I mean, in the sense that we had just gone through a very long period of calm inflation, and then suddenly, well, this whole episode and discussion of inflation is a long COVID phenomena. We had monetary policy that suddenly chose and pursued course that had never been pursued before, and in a framework never pursued before. And we've always had kind of undisciplined fiscal policy, but we kind of got drunken sailor fiscal policy over the last couple of years, and it wouldn't have happened absent COVID. Yes, we'd have overspent, but not to the tune that we did, and all the side effects of that. So I start by saying, understand that we're still living with COVID and its policy-related effects, and that's probably going to continue for a while. Go to the next chart, real GDP. And for those who are joining for the first time, when I use real, all we're doing is adjusting for inflation, nothing fancy. This is a big summary chart. The flat line marks where we were in terms of activity. You then look at the red line, the top line, the kind of linear line. That's more or less what would have happened if we had continued to grow at the pre-pandemic growth rate. The blue is actual. And you see we fell off a cliff, and then we started climbing back up the cliff. And yes, we've recovered. Yes, it's higher than it was before, but we're still about 3% below potential GDP. So when somebody tells you we have an overheated economy, which the Fed keeps saying, we don't. By any standard of what would have happened absent COVID, we still haven't fully recovered. We need a further economic recovery. Go to the next chart. Similar exercise, except done for labor. This is private sector employment. And again, you see where we started. That's the red line. You see the blue of what happened, this precipitous drop as COVID set in. We shut down the economy, around the world was shut down, and then a long recovery. And the green is what would have happened if we would have just kept adding jobs at about the rate you would have expected pre-pandemic. And we're about 1.5 million. You could get as high as 2 million, but about 1.5 million jobs short. We're not above that green line. So what that says is, again, we still have to come back more. So we have to be in the business of encouraging growth to catch up to where we should be. Go to the next chart. This is weekly initial unemployment insurance claims as a percent of the labor force. You can see that essentially everything prior to the shutdown becomes almost blips, even including really bad recessions in the 70s, early 80s, and the financial crisis become just little blips in this because the shutdown and COVID was so dramatic. And that's why we're still suffering from this phenomena. Now, the good news is, as you can see, if you look to the far right, it has come down. We stopped paying people more to be unemployed than to be employed. And as that happened, it came down, and we're really running record lows week after week. And so that's a super strong level of labor trying to recover. There's a lot of employment out there. Anybody who wants a job has one. And I would even point out, by the way, between the previous chart and this, you read the headlines of all the tech workers losing jobs, and estimates are about 1 million tech workers are identified as layoffs in 2022. But all the studies are indicating that they were getting jobs in 3 to 5 weeks. So they went from firms that overhired, but there still is a big labor shortfall, and that's consistent with the 1.5 million fewer workers than the trend. And so there's really good strength out there, and it's shown in the next chart, which is the unemployment rate. And you see in the blue the unemployment rate for the all workers, and the red being for 16 to 19-year-olds, with an average line for each of them. You see how severe this spike was associated with COVID versus other severe spikes. This one dwarfed it. Even the financial crisis got dwarfed by this one. And so it's not surprising that we have economic long COVID. The good news is that we're really low unemployment rates. And in fact, I love to look at the red in that regard because it's easy to fire teens. You see more dramatic spikes in that, and it's easier to hire them. So they're even a kind of hyper indicator data-wise. And so there's great strength in the labor market. Go to the next. If you have any doubts about how broad the strength of the economy is, you have basically 80% of the industries in the United States adding workers. And you can see that in previous strength periods, like 2018, 19, like as we had in the late 2000s, as it were, you get up around 65 to 72. That's very high. This is sustained. This is across. There's a lot of hiring going on everywhere, and so there's great strength. Go to the next chart. It's job openings and millions, and we just put marker lines for the highs and lows to help your eye. You can see how dramatically job openings spiked, and the reason there were so many job openings is we shut down the economy, we came back, demand came back faster, so suppliers were searching for workers everywhere. Workers were being paid more not to work than work. In addition, many of them were frightened to go to work. Think of the older or those with health impairments. Many had to care for their children at home, all kinds of complicated reasons. And so you had demand, lots of job openings not being filled. Well, the good news on this chart is job openings are falling towards normal. They're nowhere near back to normal, but they're falling towards normal. And that's good to have job openings kind of coming back down. That is to say, people are coming back to work. They're filling those openings. You're getting a more balanced labor market, but it still has a ways to go. And I use as a benchmark of 2019, we had about the same number of people employed in 2019 as today for a quick rounding effort. And we had nowhere near the level of job openings as we have today. So it still has a ways to go, but it's looking pretty good. Go to the next chart. This is the missing labor force. If you had to say one simple summary of why is there a shortage of workers, it relates to those. The data I'm showing here is 65 and over, but you could even go back to 60 and over. And they had the most dramatic drop in their participation. And it's for a couple of reasons. One, they were more vulnerable to COVID. Two, they were more concerned, even if they weren't more vulnerable. And the third is a lot of them were thinking about retiring in the next few years anyway. If they lost their job, they aren't going to come back. And so I circle two areas in red to show you the contrast. During the financial crisis, that's the first circle, where even during the financial crisis, the labor force participation rate of this group, unlike any other age group, went up. That is, you'd have never known the financial crisis occurred if you look at that line, 2008, 9, 10, 11. You look at this one, boy, it was really clear, really clear. It hit hard and it hit fast. So the other age categories are pretty much back, particularly non-native born are back. But we are still missing this group, and it's going to take a little while to work through it. This is an economic long COVID. It doesn't disappear instantly. Go to the next chart. Again, it underscores what I mean about why there's economic long COVID. The downturn of the early 90s looks like a blip in terms of the percent of the labor force receiving unemployment insurance. And similarly, the financial crisis looks like nothing, even though it was like 9% receiving unemployment insurance. You got up to 23% receiving unemployment insurance. Now, the good news is it's come way down. Great recovery. That's the good news. The bad news is that leaves in its wake effects, and that's why I'd liken it to the medical part of COVID. Namely, not everybody has long COVID, but there's enough of it in the economy to shake things. Go to the next, consumer confidence index. I've put the red line in is literally the average. And you see ups and downs, and the ups generally are in good times. Consumer confidence plunged as COVID set in. And then as we came out of the shutdown, it rose. We're still slightly above average consumer confidence. Now remember, there's nothing wrong with average. Average would be a kind of an average economy. So the consumer confidence is okay, not great. Small businesses, if you go to the next chart, they fell, and they fell fast. They fell as COVID happened, and they fell even further as the regulatory burdens started being imposed on them. And they're much more reactive to regulatory burdens than are large companies. They aren't in the position to lobby as much. They're not in the position to amortize the costs of regulatory compliance as larger companies. So small business optimism is still not great, but if you look to the very far right of the chart, even it is picked up in the last couple of months. Still below average, but it's picked up. Go to the next chart, and let's kind of focus on the consumer a little bit. Housing starts and auto sales. This is a chart we've done for years. Red is auto, blue is housing starts. They're both normalized around their own level to 100, so I can put them kind of superimposed on one another. And what you see is from 76, and really before 76, until about 2009, they moved coincident. They didn't move perfectly coincident, but pretty coincident. The housing shut down in about 2006. You see it precipitously plunge. And for the first time in its history, now it plunged to the lowest in its history, post-war history. And instead of starting to pop back up right away, it flatlined for 3 years. Never had flatlined like that before. And it flatlined. Meanwhile, if you look at the red, yep, it had a cyclical downturn during the financial crisis, but then pretty quickly, pretty traditionally responded. And it's only been lately that blue has come back to be coincident, more or less, with the red. That is, we're back to some degree of normalcy. Now, auto had a particular plunge after a recovery because of the chip shortage. Auto is picking up, and auto is picking up because consumers have resources, they have jobs. Consumer wealth, for example, is in real terms about 8% higher than it was prior to the pandemic. And that's in real terms, that's not in nominal. So that's a pretty decent increase to be able to realize over a 3-year period of time. And so they've got jobs, their real wealth is up. I'll come back to that. Their wages are up. Their wages have outstripped inflation during the pandemic period. People are kind of buying cars and houses. Yes, they paused. You may remember last session, I talked about what the research shows about what happens to single family housing as interest rates spike. And the answer is it pauses, it doesn't stop. And in fact, I didn't put the a new mortgage application slide in here, but in the last 2 months, residential mortgage applications have spiked, even though interest rates are high. And that's because you can only forestall so long before you decide, I've got to get my kid in school. Now, those who forestalled were rewarded by the interest rate on mortgages falling about 125 basis points as the spread narrowed. And so they were a bit rewarded, and they're acting. So this sector is showing decent strength. Go to the next chart. And this is something I've alluded to in the past, but I've never said as bluntly as I'm going to say. So this shows the home ownership rate. You can see the rise that occurred really from 1993 to 2000, 2006, about 2/3 of that rise, or effectively the rise from 1993 to 2000, was all due to the aging of the baby boom, all due to the aging of the baby boom. And then what you had was the housing bubble, and you had no down payments, you got a spike happening, and then it was very hard. You didn't have down payments, and so you got it dropped back down to about 2000 levels, and then it fell from there. Well, the reason it fell from there was the baby bust moving into their home ownership years, and the millennials not moving into their home ownership years. But by 2016, the millennials front edge was starting to move into home ownership. You see it rising. You see the spike that happened in late 2020 and 2021. And that was the spike that was allowed by not cheap interest rates. That didn't allow it. What allowed it was early inheritance from people who died of COVID. Again, another economic long COVID effect. They got early inheritance and had down payment capacity beyond what you would have normally had. Down payment capacity would have been spread over a number of years, rushed forward, sadly. And the other thing was, when there was nothing to buy in 2020, people's savings rates skyrocketed, and they saved more in 10 months than they were saving in 5, 6, 7, 8 years. So they had down payment capacity. You saw the home ownership rate spike and then normalize again. Now, one of the things that people forget is that 42% of households, not homeowners, 42% of households locked in ultra cheap mortgages prior to the run up in interest rates. And that basically, another way of saying it is that in 2002, 2020, 2021, and early 2022, mortgage rates were around 2%, and 42% of all American households, we have about 131 million households, locked in these ultra cheap mortgages. Well, what does that mean? Well, it means that instead of borrowing at something like they were doing in 2018 or 19 at around 4.5% mortgage rate, they locked in for 30 years, 2%. When you think about that, that's like $5,000 a year of additional purchasing power that 42% of the households have. The average mortgage in the United States is $200,000. So all I'm doing is taking $200,000 mortgage, and I save 2.5% on it annually. And it's about $5,000, some more, some less. These households have locked in spending power beyond the norm for a number of years. And that is going to make the consumer strong, going to kind of make the consumer king in a way. And that's another economic long COVID phenomena that was created by the super cheap rates that got created as the Fed's policies did what they did in early COVID. So this will knock on for a while. This doesn't disappear. Good news is it means these consumers are in great shape. Somebody said to me, well, what about the other 58% of households? Well, I didn't have a mortgage. So if I didn't have a mortgage, I didn't benefit from it. I wasn't hurt by it. It was just a non-event, the movement in mortgage rates. Or if I was a renter, it didn't help me or hurt me. It was a non-event. But 42% of the households is a big force to have $5,000 basically on a $55,000 disposable income. That's a big boost. So that is a powerful force that people have not understood in the economy, and it's going to be there for some time. Go to the next is the shortfall of multifamily product. And in 2002, 20 years ago, it was a more or less balanced market. We didn't have an undersupply. We didn't have an oversupply. First 3 years of the 2000s, we had a modest underproduction coming from NIMBYism, if you will, of maybe 100 to 200,000 units. The financial crisis hit, and cumulatively, we suddenly underproduced in a matter of about 3 years, 800,000 homes. That is, in fact, we were destroying more multifamily units for 3 years than we were building. And so we got to the point of about 1 million shortfall nationally in multifamily units versus a balanced market by 2014, 2015. And gee, not surprisingly, as that occurred, especially as the psychology of the financial crisis got behind people, rents grew faster than inflation because you had 1 million unit shortfall out of about 44 million rental units. Now, multifamily builders picked up their pace above normal development levels. All right, and that's why since 2015, we went from 1 million units shortfall to we're only about 470,000 shortfall. And that will continue over the next few years, presumably to go back. But as long as we have a shortfall of supply of multifamily units, you're going to see real rents go up. Not every day, not every minute, but housing is something people want, and they're going to pay up for it. One of the things we know by looking at rents in Ohio or West Virginia versus rents in California and New York City is that if I have to pay 35, 45, 50% of my budget to get a housing unit, I'll do it. I don't want to, but if I have to, I will, because I need a housing unit. So this gap still exists. Now, does that mean there's an undersupply of multifamily in every submarket of the United States? Of course not. But it does mean there is some shortfall that's out there. And it's reinforced by the fact, if you look at the next chart, that on the single family side, very different picture. In the single family, remember the multi, we started underproducing a little right off the bat in 2002. In contrast, with single family, we went from a pretty much zero, that is a balanced market, to about 2.2 million, too many units in 4 years. That is, we basically produced 500,000 more units than we needed each of 4 years to get to a total of a little over 2 million more than we needed. And then you see we shut down production. Remember that housing chart where you saw it plunge starting in 2006 and 7 and then flatline, so that by 2012 we had about the right number of units produced over that decade, done in a very odd way of overproduction and then underproduction. And then over the last 10 years, over the last decade, we have underproduced single family housing by about 3.3 million units. That's a lot of homes. That's about 3.4% of all existing single family homes. People want it. So we've underproduced multifamily a bit, and we've underproduced single family a lot. Again, not necessarily every submarket, but that puts pressure on prices. So yes, when interest rates spiked and single family potential buyers paused, demand paused. It didn't go away forever, it paused. And supply was still there. And so you've seen some tapering of home prices. But those people need to buy homes at some point, and when they come back after pausing, you're going to see real prices increase strictly on this matter. And if you look at the very end of this chart, it is not getting more negative as a shortfall. It's been flat for several years, but it's not closing the gap. Remember the multifamily, we closing the gap. This is with NIMBYism, it's hard to close the gap. Okay, go to the next chart. It's household financial obligations as a percent of their disposable income. And this is that $4,000 I was talking about. Now it's only for the number I was talking about was the $4,000 to $5,000 for 42% of households. If you then do a little blending, you say, okay, it's closer to, on an average level, 2,000, but they also locked in a lot of other interest rates at low levels. So what the newspapers do is, H.L. Mencken had this wonderful quote from the 1930s that the media and the politicians are intent upon frightening us to death so that they need us, and look to us being the media and government. And I think that hasn't changed since Mencken wrote that in the 30s. What you see in the press is to the far right of this curve, which is, financial obligations have risen a lot from their low in early 2001. And that's factually true. You can see it went from just under 13% of disposable income to over 14%, approaching 15% of disposable income. So it's a true statement. It's just not a very insightful statement, because if you look at it versus the red or the blue, is that we're way below norm. We're below where we were all of the 2010s, all of the 2000s, the 1990s, and so forth. So the consumer is still in pretty good shape, and that's that extra money. Go to the next chart, corporations, and you see corporate profits in real terms are high. The red is they're quite high. Remember, if the red is flat, all it's saying is profits are rising at the same rate as inflation. So real profits are quite high. And if you look at the green, which is distributed, whether it's done by buybacks or distributions or dividends, also quite high. So the corporate sector is solid. You're going to see them not do quite as well. Why? Because they printed money when demand came back faster than supply. You see that spike that occurred, and that was demand came back. Hello, can you hear me? Bruce, can you hear me?
Yes, you're back.
Yeah, I just got rung off. I don't know how. It just started playing music. I hope you enjoyed the music. The point being is that profits are quite high. They're being distributed. They'll come down a little as more supply comes online and it's harder to compete. Go to the next chart. Industrial output up about 1.6% in 2002. Not so abnormal. We're above pre-COVID. Still issues. There are still some supply chain issues there, but we've come a long way, and industry's doing pretty well, although being a little guarded. Go to the next chart, real. So again, adjusting for inflation. This is quarterly flow of sales as best I can estimate them going through brick, so to speak. And there's no clean data. This is best I can estimate. The red line just does what you would try to do with your line, which was what was the pre-pandemic high. Again, remember, flat here means keeping up with inflation. So what you see is huge drop as the pandemic and the shutdown occurred, couldn't go to malls, etc. And then, as we predicted, made a huge rebound and has been pretty flat for the last year or so in real terms. That is to say, it is keeping up with inflation, but you're not getting huge growth. But on the other hand, you're not getting shrinkage. Good retail is in better shape than it was in 2018-19. because we found out what we know much better today, what can and cannot be produced profitably online and distributed profitably online. And we didn't know that. We had hunches, but in 2017, 2018, 2019, we got battle tested in this sector in 2021, early 22, such that you know what cannot be sold. In particular, groceries cannot be sold. Low margin items can't be sold profitably online. And so you've got a kind of a recalibration and a rediscovery that brick shopping is fun if done in a productive environment. You go to the next, and it shows e-commerce sales, as best I can estimate them, as a percent of total retail sales. And you can see it was kind of moving along a trend, steady trend upward, no doubt. And you see 2018, 19, you're kind of going, well, where's it end? And then you had the spike. And that was the test. That was people saying, oh, well, they'll never shop in bricks again. I said, nonsense. It just time shifted stuff. And it's kind of flatlined, coming back to trend. And I don't mean literally trend. I put a trend line just to help your eye. I don't mean literally trend. I just mean kind of more or less trend. And it's behaved exactly as I said, actually in March of 2020. I've not changed my story on this. And it's not to say retail sales aren't going to occur online. It's not even to say they won't increase. It's just to say be realistic. And in that regard, remember that about 6 out of every $7 sold, not including auto, are sold in brick, not online. And yes, online grows, but go to the next chart, you see another economic long COVID phenomena, and that is interest rates. And so interest rates, red went, the short-term rate, the blue, went to zero. And you see it stayed at zero for about 18 months. And the Fed said, basically, we were going to do something very similar to what we did in the 2010s. If you look at the blue line in 2010s, it was flatlined for 8 years at zero. And so people, right or wrong, basically interpreted that the short rate was going to be low for quite some time. And then in the middle of last year, a little past middle last year, the Fed said, oops, we were only kidding. And I had said before that the Fed is a terrible predictor of themselves. And you see how quickly they rose, that they increased that rate. And anybody who believed the Fed got caught off guard. Some of you that are developers, you believe the Fed, you got caught off guard. I got caught off guard. I knew better than to trust the Fed, and I trusted the Fed. And so that was the phenomena. You look at the red, the long rates like 3.5, 3.6, 3.7. There's nothing abnormal about that. But that shooting up of the short rate caught a lot of banks in their inventories in loss positions. They stopped lending because they didn't want to sell their loans at losses to recycle the money to get fees. And they held them so they could get bonuses. As this year unfolds, their bonus targets will reflect them selling loans at losses out of their warehouse. As they sell them, they will recycle that money. As they recycle that money, money will flow. My research shows that when money doesn't flow, cap rates go up. Doesn't matter what the reason is why money doesn't flow. There have been many reasons over time why money doesn't flow, but when it doesn't flow, cap rates go up. And that's what you saw in the latter half of 2022 and early this year, is to the extent there was any price discovery, cap rates were up. But it was not due to interest rates. It was due to money didn't flow. And in this particular instance, money didn't flow because interest rates are up. But historically, when interest rates are up, more money flows, not less. So this was an aberrant situation. The important thing is that when money flows, my research shows cap rates go down. and it does it basically irrespective of interest rates. I've been very public about this. We've published about this. I've written about this. No one has ever come back and said your analysis of the data is wrong. All right, no one. And we've written about this in great detail. We urge you to look at Linneman letter and others to see where the research is on this. So why did the Fed raise the rate? Well, the Fed said we're worried about inflation. I'm going to come back to that in just a second. So we have a high short rate and a normal-ish long rate. We have an inverted yield curve. By the way, there is no good predictor of a recession. There's no good predictor of recession. So, and including that negative is inverted yield curve. All right, let me just move quickly. The next chart just shows excess bank reserves. And the only point of this is, yes, their reserves that are excess are going down. They still have staggering amount of reserves in the bank. They can sell their money, they can sell their loans at a loss and not go out of business. Now, the next chart we prepared just before the data came out this morning. It's the annualized monthly inflation rate. That is, if you take month-to-month inflation and you don't literally multiply it by 12 because it's a compound formula rather than a linear formula, but you annualize it. And you can see that 2019, we had very low inflation rate. You can see in early 2020, when nothing was bought, nothing was sold, we had big deflation. And then you start seeing this period of aberrant high inflation running up in the 8 to 10% range. Except if you look at the end of this chart, which ended with December data, we really have had no inflation. Now, you see headlines saying year over year, but I don't care about a year over year. I care about what's going on now. So I just, truly this morning, the data came out. We didn't have time to update this chart. I'm going to give you two numbers. If you take the inflation data, the consumer price index, core, urban, et cetera, and you take it from the last 6 months through January's data, the annualized rate of inflation is 2.6%, which is hardly a problematic inflation rate. And if you take the last 3 months, that is the last January, November, December, January, it's 1.9%. Neither of those are problematic inflation rates. The year over year, therefore, the only reason year over year is in the 5 and 6% range relates to how low a year ago was and the increases that occurred prior to the last 6 months. Well, I don't care about that. I care about what's going on. I don't care about, I've already accelerated the automobile. I care about what my current speed is. And my current speed, my current inflation rate is basically somewhere around 1 to 2% inflation. And in fact, December it was actually negative. Why did the Fed raise the rate? I have two answers. One, I have no idea. And the second is, I went to Catholic schools in the old days, and they would punish the kids, mostly the boys, and give them an extra whack or two for good measure. Not for good reason, but for good measure. And I think you're witnessing whacks for good measure. If I told you the inflation rate is essentially 1.5 to 2.5%, why would you have a Fed funds rate at 5%? That would make no sense. And yet that's where they're at. They should have lowered the rate in this, instead of raising it. And they're probably going to raise it again instead of lowering it. 50 years ago, 50 years ago, I sat in a classroom as a new graduate student under Milton Friedman. And I heard him wax eloquently about the Fed always being late and always overreacting. And I've not seen much in the last 50 years to change that view. And I've seen nothing in the last couple of years to change that view, and you're just living through one more episode. And the problem is economic long COVID created the phenomena of really overreacting. So they were really late and they really overreacted. All right, go to the next, and it's an index, the Fed's index of supply chain pressure. And you can see that it got 4 standard deviations above normal. Any of you who know anything about statistics, 4 standard deviations above normal? I mean, that's extraordinary. And now it's back down to about a standard deviation. That is to say, there's still more pressure to come off of the supply chain issues, which will further lower prices. So we're in a situation where at some point the Fed is going to realize they've way overshot. And go to the next chart. There's nothing magic about M2 as a money supply. It's hardly a perfect measure of liquidity. It was a much better measure 30, 40, 50 years ago than it is today. But you can see where I circled the money supply measured by M2 is actually down 1.3%. You don't see periods of down. So they probably have overreacted and they did it too late. And go to the next chart. The reason we didn't have inflation created by money is that the velocity fell. So they put more money in and we just put it in our mattresses. And if it's not circulating, it couldn't bid up prices. It was supply chain issues. And I'll do the one more chart, Bruce, and then I think I'll stop, and the other charts are there. The last chart I'll talk about is checking deposits and currency. We still have, depending on what period you want to measure it, something like $4 to $7 trillion beyond any kind of normalized trend of cash holdings, which is to say that money got injected over the last 12 years, but most of the money that got injected sits in cash, either corporate cash or in personal cash. And that is pretty extraordinary. To the extent it comes out, it will chase assets much more than goods and services. Let me then just summarize. There's a chart in here for each of the major real estate food groups. Industrial still staying very strong at record levels. Online sales mean lots of demand for industrial space. Multifamily real rents have peaked. They're still way above. They're still way above the norm. The reason they're off their peak is, remember how you saw the shortage of multifamily shrinking? When, not surprisingly, the real rent was at its peak when the multifamily shortage was at its peak. Office real rents are essentially at record lows, and there's a real issue trying to figure out how it works forward. I think people come back to the office, but that's a big challenge. If you look at retail, real retail rents are at their low, although that's misleading, because if you look at the strong retail locations, their real rents are below average, but they're not terrible, and they're rising. If you look at those in bad centers where nobody wants to shop, they're still falling. And then the last is hotel. The hotel sector is got RevPAR above its average, below its peak. And so it's still about 8% off of its peak in real terms. And then, Bruce, you could go to the last chart that just says big questions abound. Is inflation over? I think more or less yes, with, if anything, it's going to get even lower moving forward as supply chains, as that one standard deviation of supply chain pressure further erodes. Will there be further asset to price deflation? No, I think the banks will start lending late in this quarter as they sell portfolio and recycle money. And as that happens, money will come out, equity will come off the sideline. And as money flows, asset pricing will improve, particularly cap rates will improve a bit. Will there be a recession soon? No, because of the consumer. Although the Fed is desperately trying to create a recession, I think the consumer is too strong. And I hope the Fed will eventually wise up that they're fighting the wrong war. Will Fed raise rates too high? They've already done it. Will they be late bringing them down? Absolutely. How much is regulation slowing growth? It is definitely slowing growth, but not as much as probably a headline. If you made me guess based on the research historically, it probably knocks 20 to 30 basis points of growth off of GDP versus normal regulatory activity. To have a more aggressive regulatory environment probably knocks 20 to 30 basis points off GDP growth. And will people work at offices again? Absolutely. I will give you one. I saw a survey last week that something like 5% of federal workers are back in the office. 5%. Anybody who argues that that's because it's much more productive to work at home, I ask you to ask yourself, have you seen a massive increase in the productivity of the federal government in the last year or two as everybody's working from home? I leave it to you to answer that question, Bruce, and for our listeners to do. So we have about 10 minutes for questions.
Great. Thank you very much, Peter. Yeah, we have several folks writing in. Just wanted to get a little clarity on how you are solving for when you say that there's a shortfall of multifamily units and the shortfall of single family housing. Do you mind just giving a little bit of insight onto that?
The real simple way, there are two ways, but they're both at the end of the day pretty close to one another. One of them is you basically take some long-term average of how many single family or multifamily units were absorbed each year. And you take some long-term average of that, you compare it to how many units were actually produced. And you do that over the 20 years. That's one way. And the other way is the same exercise with a little more subtlety, which is you do the same exercise except instead of on a long-term average, you do it on the number of households that were formed over that period, and then you apportion them to renter and owner accordingly, and you come up with a number. And the only reason that's a little misleading, they're both misleading in their own way slightly, is that the run up in rents and the run up in home prices causes some people to double up, and that reduces the number of households that would have been created. And I'm not the only one that's done it. Any number of analysts have done it. The numbers on single family I've seen as low as 3 million people estimate. I told you we come out around 3.3. I've seen numbers as high by good estimators, by good analysts, as high as 4.5 million single family, and not too different than my multifamily numbers. That's a simple way to describe the methods.
Great, thank you. And as a follow-up to that, so if there is this shortfall in multifamily, for example, what do you think is behind the rent corrections that we're seeing across several markets? Is this just a symptom of the fact that you're looking at things nationally and there is no national market per se?
There's two things. I think one, what you just said, Bruce, there's a kind of, you got to average it up, and the averages don't always smooth out. But I do think there's a second phenomena, which is, again, economic long COVID. We had this reaction where we had this surge beyond normal apartment demand, right? We had normal apartment demand growth because of population and so forth. But then we had this surge. We had this surge that was created by a lot of unemployment money beyond anything people thought. We had the surge created by various, I don't have to pay my student loan, so I've got more money than I thought. We had a surge created by people who had roommates, including their parents as their roommates, if you will, who were happy to be at home or with a roommate as long as they could work all day and party all night. And then suddenly with COVID, they couldn't work all day except at home, and they couldn't party all night. And they said, I got to get my own place, or their parents told them they got to get their own place. And so you had this surge of about 1 million households that happened beyond norm. And that was that big, big push you saw. Well, that wasn't going to happen forever. And I said at the time, it's real, but it wasn't going to be another million and another million beyond norm. So part of it is whenever you see these surges, Bruce, people incorrectly, linearly extrapolate. And I think people thought, well, if I can go from $1.50 a foot to $1.65 in the first quarter, I can go from $1.65 to $1.80 the second, and I can go from $1.80 to $2 in the third. And at some point, you can't, because there was only that one push. And so there was some overshoot. And I think the revenue models, knowing statistics as I do, I think the revenue maximization models, basically they said, if you see occupancy in 94% and you see a push, do this. If you see it in 95% and you see demand, do this to the rent. But the data had never really said, what about if you're already at 98%? What do you do? And I think just statistically, those revenue maximization models pushed rents too far. They pushed them beyond the data, and now you're retrenching, saying, aha, we've never been here before.
Great, thank you. What concerns you at this point? You mentioned before that the Fed caught you off guard, even though you knew better. What concerns you now? Where do you think you might, in a month or 3 months or 6 months from now, say, I wish I had known?
Okay, so what concerns me, shifting from my Eagles hat to my Sixers hat, is that Joel Embiid gets hurt and we don't have him to make a championship run. In terms of the economy, what concerns me is that Milton Friedman was probably right when he said they are too late and they overreact, which means they're not, they being the Fed, they're not done overreacting up, and they're going to do more damage in the process. And what concerns me is he's probably right. Remember, he didn't know who these Fed members were. He was making a kind of institutional DNA prediction or description. And I think the lateness means they're going to do damage. They're going to take a while. They're going to misallocate resources. So that does worry me. That concerns me of how late and how overreactive will they be? Because if they're sufficiently late and sufficiently overreactive, they can do a lot of damage. So far, they've only done limited damage.
Okay, great. Any parting thoughts for the group, Peter?
Well, let me just say, we hope your new year is off to a great start. Remember that real estate is a long-term asset. Yes, you have to be concerned about what's happening now, but if you look at a lot of these charts, the long-term is good. And we happen to be in a country where the long-term, in spite of our politicians of all ilks, in spite of weather, in spite of, we generally do better. And as an owner of real estate or an investor or creator of real estate or a lender to real estate, service provider, you will do well if you focus on the long term. Try to be aware of the short term, but remember, if you bought an asset today and you financed it at today's interest rates and so forth, and you did, as long as you can work that asset over the next 20 years productively, and as long as you adjust to markets as they adjust, and you take advantage of the good times. You try to minimize the effects of bad times. 20 years from now, when your heir does an accounting on how that property do over the last 20 years, how it did in the first 2 years will not be a big determinant of how it performed over the 20 years. And I just think it's healthy to remind ourselves of that once in a while, because there's a tendency to believe what happens in the next year or two is the determinative factor. So I would end on that, Bruce, and I thank you and I thank everyone else.
Great. Thanks so much, Peter. Yeah, just a reminder, this presentation is really just a tiny sample of what's presented in a lot more detail in the Linneman letter, which is a subscription from Linneman Associates. And that you can learn more about that at linnemansociates.com. Just a final reminder, if you're registered, you will automatically receive an email link to the recording in about an hour. Well, thank you again to everyone, and we will see you next quarter, and be safe and well.